Look at this chart. We've all seen the massive upward curves promising that saving a few dollars a week will eventually make you a millionaire. But if you're actually following the standard advice, starting small and being consistent, your account balance likely looks like this flat line resting at the bottom. There is a massive gap between theory and reality. If you put $50 a month into a standard index fund earning an 8% average return, after 12 full months of discipline, your money makes you roughly $4. The math is technically working, but the output is too small to notice. Because that growth is microscopic, many new investors assume the interest rate is the problem. They get bored, abandon safe index funds, and start trading their portfolio like a casino, chasing volatile crypto or speculative stocks, hoping for a 15 or 20% return. The charts they show you in high school economics leave out a crucial detail. Compound interest has a strict size requirement. Your balance has to reach a certain volume before the percentage yield translates into meaningful dollars. Compounding is real, but it only functions in a way you can feel once you cross a specific mathematical threshold. Until you hit that number, the early years of investing always feel slow, manual, and frustrating. This period is phase 1, the contribution phase. For the first decade of your wealth building journey, your monthly input is the only variable that actually drives your net worth. This side-by-side comparison shows exactly why. On the left, we have a high-risk strategy, investing $200 a month and doubling your return from 8 to 16%. On the right, we have a safe strategy, keeping an 8% return but increasing the contribution to $350. Over 10 years, the larger contribution builds $64,000, easily outpacing the high-risk gamble. And that assumes you actually hit 16% every year. In reality, chasing yields exposes you to massive volatility. When a bad year wipes out half your portfolio, your starting balance is simply too small for a high rate of return to save you. Adding more money to your monthly contribution does the same heavy lifting as doubling your interest rate, but it requires zero extra risk. You are aiming for a specific target called the border crossing. Based on historical market data, the threshold where your money takes a life of its own falls roughly between $100,000 and $150,000 in total assets. Your objective as a beginner is not to find a clever trading strategy. Your only job is to survive phase 1 and push your account balance to that $100,000 mark as aggressively as you can. Take a look at the effort split during those grinding early years. If your account grows by $240 in a month, you are contributing 83% of that growth yourself. The market is only providing this tiny sliver of 17%. But at the $100,000 mark, the math violently inverts. At 8%, your portfolio suddenly generates roughly $667 a month in returns, without you adding an extra dime. If you are still putting in $200 a month, the investment is now doing more than 3 times the work you are. Wealthy people seem to get richer without effort because they are operating at a scale where percentages generate significant dollars. It is a matter of volume, not secret strategies. Crossing into phase 2 shifts wealth creation from active labor to a background physics equation. It permanently accelerates your financial trajectory while you sleep. The ultimate mindset shift is this: compound interest is not the strategy. Compound interest is the result of relentless, aggressive contribution growth. To accelerate through this barrier, you need to audit your finances today. Look at your spending and figure out how to increase your monthly investment by just $50 this month. Then, set up an automatic transfer on payday. Treat your investment contribution like a fixed bill that gets paid before you ever see the cash, because what's left over at the end of the month is usually nothing. When your income goes up from a raise or a side hustle, take half of that new money and route it straight into your portfolio. Your lifestyle improves, but your future gets built twice as fast. When you see someone online showing off thousands of dollars in passive returns, remember that they spent a decade grinding through invisible growth to get there. They just didn't post about it. The beginning of this journey is supposed to be slow. It demands extreme patience and consistency rather than flashy maneuvers. If you can ignore the noise and focus entirely on maximizing your monthly inputs, the math will eventually tip in your favor. You just have to push your pile past at threshold and let compounding finally do the